228 billion. That is the number of UPI transactions India processed in 2025 alone. For context, Visa processed approximately 233 billion transactions globally in its entire fiscal year. India's homegrown payments rail is now operating at Visa scale. Welcome to Asia Tech Macro. I'm Alex.
And I'm Maya. Today, we're diving into India's digital payments revolution because two things happened in the past 6 weeks that make this the right moment to take a serious look. First, Apple confirmed it is in active talks with ICICI Bank, HDFC Bank, and Axis Bank to launch Apple Pay in India by mid-2026. Second, the NPCI announced plans to expand UPI's reach to East Asia and Gulf markets, targeting what it calls global payment standard status. Those two stories are on a collision course.
Let's set the data foundation. UPI processed 21.63 billion transactions in December 2025 alone, up 29% year-on-year. The daily average hit 698 million transactions. Annual transaction value reached 299.7 lakh crore rupees, roughly $3.5 trillion. The user base has crossed 500 million unique users as of early 2026, with a target of 1 billion by late 2026. PhonePe leads with 48.3% market share, Google Pay holds 37%, and Paytm sits at 7.82%. Together, the top three process nearly 94% of all volume.
And the international expansion numbers are striking. UPI is currently live in 27 countries, including France, Singapore, UAE, and Sri Lanka. NPCI has signed agreements with Peru and Namibia for UPI-modeled systems by 2026 to 2027. The integration with Singapore's PayNow, enabling real-time cross-border transfers, is already a template being studied by central banks across Southeast Asia and the Gulf.
Now enter Apple. Bloomberg reported in January 2026 that Apple Pay India is targeting mid-2026 launch, with plans to support both UPI and traditional card-based transactions. Apple is in talks with Indian regulators and global card networks including Visa and MasterCard. The strategic logic is clear. India has record quarterly iPhone shipments, a rapidly expanding premium consumer segment, and a payments infrastructure that is technically sophisticated but aesthetically fragmented. Apple Pay's Face ID and Touch ID authentication versus UPI's PIN-based flow is a genuine UX differentiator for the iPhone user base.
But here's the tension that makes this story fascinating. UPI is free. Zero transaction fees for users, near zero for merchants below 2,000 rupees. Apple Pay's model globally relies on interchange revenue from card networks. Those two business models are not easily reconcilable. In Part 2, we dig into what that collision actually means. Stay with us.
Okay, Segment 2, the business model collision. Because this is not just a technology story, it's a fundamental conflict between two incompatible theories of how payments infrastructure should work. Maya, let's get into the economics.
Right. So UPI's zero-fee model was a deliberate policy choice by the Indian government to drive financial inclusion at scale. It worked spectacularly. But here's the uncomfortable reality. Nobody is making money at the infrastructure layer. NPCI is a nonprofit. PhonePe and Google Pay have been subsidizing growth for years. PhonePe was valued at $12 billion in its last funding round, but has never reported an annual profit on its payments business. The entire ecosystem is running on the assumption that monetization comes later, through credit products, insurance, wealth management layered on top of the payments rail.
And that assumption is being tested right now. The Indian government extended its zero MDR merchant discount rate policy through March 2026, but the industry is loudly lobbying for a fee structure to be introduced. The Payments Council of India submitted a formal proposal in January 2026 requesting a tiered MDR framework of 0.1 to 0.3% on transactions above 2,000 rupees. If that passes, it changes the entire profitability landscape for every payments player in India overnight.
Okay, devil's advocate. Isn't the zero-fee model actually a strategic moat? Because if you're Apple Pay trying to enter India with a model that depends on interchange revenue, you're immediately at a structural disadvantage versus a free incumbent with 500 million users. Apple Pay in India might be a premium product for 50 million iPhone users rather than a mass market play.
That's exactly right, and I think it's underappreciated. Apple Pay India will almost certainly not displace UPI for everyday transactions, the chai, the auto rickshaw, the Kirana store. Where Apple Pay can win is in the premium segment, high-value e-commerce, international transactions, and the integrated hardware-software experience for iPhone users. It's a niche within a massive market. The question is whether that niche is large enough to justify the regulatory and operational investment Apple is making.
And the deeper strategic question is about data. UPI transactions flow through NPCI's infrastructure, which means transaction data stays within India's regulatory perimeter. Apple Pay's global data architecture is fundamentally different. India's data localization requirements under the Digital Personal Data Protection Act create real friction for Apple's standard operating model. Vivek Belgavi, financial services technology leader at PwC India, noted in a February 2026 industry conference that any foreign payments player entering India must now architect their data flows entirely within Indian infrastructure, which is a significant operational constraint that doesn't exist in other markets.
Which brings us to segment 3, the ripple effect. Because India's UPI model is now being actively exported, and that export has direct implications for Visa, MasterCard, and the entire global card network business model.
The numbers are significant. Visa and MasterCard combined process roughly $15 trillion in annual payment volume globally. Their business model depends on interchange fees averaging 1.5 to 2% per transaction. If the UPI model, zero fees, government-owned rails, open API architecture, gets adopted across Southeast Asia, the Gulf, and eventually Africa, it represents an existential challenge to that fee-based model in the world's fastest-growing payments markets.
And it's not hypothetical. Singapore's PayNow, Brazil's Pix, and now Peru and Namibia's planned UPI-modeled systems are all variants of the same template. The RBI's executive director, Rohit Rishi, stated in a January 2026 speech that India aims to position UPI as a global public good, explicitly framing it as an alternative to card network dominance. That's a direct challenge to Visa and MasterCard's emerging market growth thesis. And in part 3, I want to challenge whether UPI's global ambition is as achievable as the RBI believes. Don't go anywhere.
All right, contrarian corner, and my uncomfortable view today is this. UPI's global expansion story is being significantly overhyped, and the reason has nothing to do with the technology. The technology is genuinely world-class. The problem is governance.
Governance? That's not the angle I expected.
Here's the argument. UPI works in India because of a very specific set of conditions that are extremely difficult to replicate elsewhere. You have a central bank that is both technically sophisticated and politically empowered to mandate bank participation. You have Aadhaar, a biometric identity system covering 1.4 billion people, providing the KYC backbone. You have a government willing to subsidize zero fees for years to drive adoption. And you have a domestic market large enough that network effects kick in fast. Remove any one of those conditions, and the model degrades significantly.
So the Peru and Namibia agreements
Are diplomatic achievements, not business transformations. Signing an MOU to study a UPI-modeled system is very different from actually deploying one at scale. Brazil's Pix is the closest successful analog, and it took the Brazilian central bank 4 years of intensive implementation work with a highly capable domestic banking system. Most of the countries signing UPI partnership agreements do not have Brazil's institutional capacity. The gap between the press release and the working product is measured in years and hundreds of millions of dollars of implementation cost.
That's a fair structural critique. But isn't there a middle path where UPI doesn't need to go direct to consumer globally, but instead becomes the backbone for cross-border institutional settlements between central banks? The PayNow UPI corridor between India and Singapore is already doing that effectively.
The central bank corridor model is genuinely promising, and I don't dismiss it, but it's a very different story from UPI becomes the global payment standard. Central bank corridors handle a fraction of total payment volume. The vast majority of transactions, consumer, merchant, e-commerce, still flow through private networks. For UPI to truly challenge Visa and MasterCard at scale globally, it needs to win at the consumer layer in multiple large markets simultaneously. That is an extraordinarily difficult organizational and regulatory challenge that NPCI, as a domestic nonprofit with 500 employees, is not currently structured to execute.
So the contrarian view is UPI is a spectacular domestic success story that is being extrapolated into a global payments dominance narrative that the institution behind it cannot actually deliver.
Precisely. And the investment implication? Don't short Visa and MasterCard on the UPI global threat thesis. Their emerging market revenue is safer than the headlines suggest. The real disruption risk to card networks comes from domestic fast payment systems in each country, Brazil's Pix, Europe's SEPA Instant, potentially a future US Fed now at scale, not from UPI specifically going global.
And here's my question for our listeners. India has built the world's most sophisticated public payments infrastructure and given it away for free. PhonePe has 500 million users and has never made a profit on payments. The monetization layer, credit, insurance, wealth management, is still being built. So here's what I want you to think about. In 5 years, when UPI's monetization finally arrives, who actually captures that value? Is it PhonePe, which owns the customer relationship? Is it the banks, which own the credit products? Is it the government, which owns the rails? Or does a foreign tech company, Apple, Google, potentially a Chinese platform, come in at the monetization layer after Indian companies did the hard work of building the user base? That question should be central to every fintech investment thesis on India right now.
That is exactly the right frame. Part 4 has our answer. Stay with us. All right, action items. 3 concrete things to do with everything we discussed today.
Number 1, focus on the monetization layer in Indian fintech, not the payments rail itself. The payments infrastructure is essentially a public utility at this point. Zero fees, government-owned, non-profit operator. The value creation happens one layer up. Credit scoring using UPI transaction data, embedded insurance, mutual fund distribution, and BNPL products built on top of the payments relationship. BharatPay, which processes UPI payments and layers small business credit on top, is the clearest example of this model working. Bajaj Finance, which is integrating UPI data into its consumer lending underwriting, is the large cap proxy. The thesis is, own the data relationship from payments, monetize through financial products. That's where the margin lives.
Number 2, don't short Visa and MasterCard on the UPI global threat thesis. The card network's emerging market revenue is more durable than the UPI expansion headlines suggest. The real near-term risk to Visa and MasterCard in Asia is not UPI going global. It's domestic fast payment systems in each country eating into low-value transaction volume. But high-value consumer transactions, cross-border e-commerce, and corporate payments remain structurally card-friendly for the foreseeable future. If you're underweight Visa and MasterCard because of UPI anxiety, the data does not support that positioning. Both stocks trade at reasonable multiples with durable emerging market growth that the UPI narrative is incorrectly discounting.
Number 3, watch Apple Pay India's launch timing and initial merchant adoption as a leading indicator for the premium fintech opportunity. If Apple successfully launches in mid-2026 and achieves meaningful adoption among India's 50 to 70 million iPhone users, it validates the thesis that a significant premium payment segment exists above the UPI mass market. That would be a positive signal for every premium fintech player in India, from Zeta, which provides banking infrastructure to premium card issuers, to HDFC Bank and Axis Bank, which are Apple Pay's rumored banking partners and would benefit from increased card transaction volume among high-value customers.
The takeaway for today: India has built one of the most extraordinary financial infrastructure stories in modern economic history. UPI at 228 billion annual transactions, 500 million users, and $3.5 trillion in annual value is a genuine achievement that no other emerging market has replicated at this scale or speed. But the business model question, who captures the economic value from this infrastructure, remains genuinely open. The rails are built, the monetization race is just beginning, and the winner may not be who built the rails.
And the meta lesson, in platform businesses, the infrastructure layer commoditizes and the value migrates to whoever owns the customer relationship at the moment monetization becomes possible. India's fintech sector is about to find out who that is.
Next time on Asia Tech Macro, we're looking at the EV battery supply chain across Asia, China's CAT-TL dominance, South Korea's response, and what Japan's solid-state battery bet means for the entire industry. The chemistry is changing, and so is the competitive map. That's next.
That one has been on my radar for months. Cannot wait.
Stay data-driven. Bye.